Let me start tonight by saying first of all, my name is Henry Lapham. I'm the Leadership Giving Manager here at the Home for Little Wonders. Lots of people often say when I give my name out, they go, "Oh, you're the guy who's been sending all those emails." Or, "Oh, you're the one who left those voicemails for me." That is me. I do exist. I'm not AI generated. But I like what we got here. If you want, we can do some bunny ears.
That wine looks good.
We're thrilled to have you here for a couple of different reasons. One, obviously because we are launching our Pembroke Future Society, or Youth Society this year. And we've got a wonderful dinner and a fireside chat with some staff members and former clients to share a little about their perspective of the home and why it's so important to them. But for the next hour, you're going to get to hear from Erica Webb, who is at Boston College, works in the Plan Giving department. And she's going to spend a little bit of time breaking down plan giving, the different options, and things like that. I will be the first to tell you that when we said, let's do a plan giving seminar, I said, let's find a speaker. I can give you the topic sentence. I'm a former fourth grade teacher. I can give you the topic sentence. She can give you the supporting details.
Oh, I like that.
Yeah, there we go. Without further ado, Erica, take it away.
Oh, thank you. Thanks, Henry. Thank you, everybody. I love that it's a small group. This is going to be a lot of fun. So as Henry said, I'm at Boston College. I've been there managing the gift planning program for 10 years now. But I've been doing this for about 25 years. Prior to BC, I was at WGBH, overseeing their gift planning program as well. And really, I started at Harvard. So I was kind of lucky I got all my training there, because that is a very well-resourced institution that they do anything and everything, all kinds of gifts. So I learned a lot from that. Also, just to give you some of my credentials, if it's helpful, I also serve on the National Association of Charitable Gift Planners board. There is a group of people like me. There's a lot of nerds just like me all across the country. We like to get together. We actually were just in Indianapolis about a month ago, about 1,100 of us in a room for 2 days, not many rooms for 2 days, talking about some of the stuff we're going to talk about today. So I love this topic. You'll see I'm kind of passionate about it. One of the things I love is just really helping people like you and at Boston College, like helping our alumni, figure out how to support an institution that they love, that has a great mission. But how can I make it work and have the biggest impact for yourself and for the institution? So that's why I do what I do. So here's the agenda. So I'm going to give you, like Henry said, a plan giving overview, just kind of talk about what it is, dive into the ways of giving. And some of these you may have heard of, you may have done. Talk about a little, one other little important piece of information that I hope will be helpful for you. And then I put question and answers at the end, but I don't want to talk at you all night. Let's have this be a conversation. So just chime in if something I'm saying doesn't make sense. If you need me to speak louder, softer, just let's have a conversation. Let's have fun with it. And you'll see I can kind of nerd out. So if I see eyes glassing over, I will I will try and shift. I really love this topic. So, what is planned giving? Are there anybody here in this room, have anybody done a planned gift? Or do you even know what a planned gift is? What is a planned gift? Do you have any idea?
I imagine it's, you just say, planning to give, be it in your will or trust or something.
Yeah. It's really kind of like what I was just saying, how we can help you figure out when you're thinking about your personal, your financial, and your philanthropic planning, how to maximize that for yourself, for your family, and for an institution you love. Quite often, it's a gift made in a will or a trust or your IRA or some other financial vehicles that I'll talk about in a minute. But one of the biggest pieces, it's this, helping you to create a lasting legacy. Quite often, and you'll see why when we go through these slides, a planned gift is going to be the largest gift that people make, not typically during their lifetime. It's something that will be realized after your lifetime more often than not, but it's a way to help you have that impact, make that impact. I can tell you at Boston College, out of our top 10 gifts, I would say 5 of them are planned gifts, and our largest gifts have been these estate gifts that have had a huge impact on the students there. So what we're talking about tonight is a way to help you figure out to have the greatest impact on the kids from the home. Yeah, let's just get into it. Let's just have some fun here. So, actually, I knew what I wanted to talk about. Lasting legacy. Okay, so a couple things. I really nerded, the history nerd in me really nerded out when I was reading about the home. I had no idea Abigail Adams was one of the founders. So that's a lasting legacy. I mean, she helped to start this. But there's also another very remarkable woman, and we were just talking about this a minute ago, Edna Betts Talbot. So in the 60s, 1963, does that sound right? She left her entire estate to the home. And from what I understand, you're still receiving payments monthly from her. So it's over 50 years, over 60 years almost? Yeah, so over 60 years. So she has had a lasting impact on this institution. So I want to help you figure out if you can be the next Edna Betts Talbot. I mean, we'd all love to be, right? Yeah, you're on your way. We're going to do this together. And I can tell you, at Boston College, we have an organization called the Shaw Society, where we recognize people that leave Boston College in their estate plans. It was set up by a Jesuit before Boston College was established. He left his insurance policy and some books to BC, and the goal of it was to help establish a college for the sons of Irish immigrants. And there you have it. You have Boston College. John Harvard. He left insurance policy, also, I think, some books and some money, and then you have Harvard. So this is how you can be the next John Harvards or Edna Betts of the world. So let's dive into it. There's a lot of different ways of giving. These are really the most common: bequests, beneficiary designation, and I'm going to go into detail for each of them. And also, we gave you some slides to take home, so you can, and feel free to take some notes. But bequests, beneficiary designation, life income gifts, which I'll explain in a minute, CGAs, CRTs, you can see we love acronyms in this work. And I'll tell you what those acronyms mean in a minute. QCDs, IRAs, I mean, we really love acronyms. But these are the most common types of gifts that I see in all the years that I've been doing plan giving. There's a lot of other, but this is what you're really gonna see and what's gonna have the most impact, honestly, at the home. So what are those? Before we do it, I just kind of wanna do some table setting, or just so we're all on the same playing field. I'm sure these are terms, or I don't want to assume these are terms you all understand, but I'm going to talk about these as we go forward. So, what is an estate? It's everything somebody owns, including assets or liabilities. And so then what's a bequest? It's really, how are you going to pass those on? How are you going to transfer that wealth, whether it's to a person or a charity or an organization after your death? And then what is estate planning? It's the combination of the two. How do I make this work? So that's the building blocks of everything we're going to be talking about, and with all these different gift vehicles. So how do these gift vehicles kind of fit in to this here? So the first one, making a bequest. Most common, the easiest type of gift anybody can make. You're leaving a specific dollar amount or a percentage in your will. You can leave a specific asset. For example, if you think the Nature Conservancy, a really large national organization, they get a lot of people, actually thousands of people leaving land to them. And that makes sense because they need that land. They want to protect that land. Museums get artwork all the time. So you can think about leaving a percentage, a dollar amount, or a specific asset. And even if you're leaving a specific asset to in an institution, they may not be able to use it, but they can liquidate it and use it. And then there's beneficiary designation. That is, quite honestly, the easiest type of gift anybody can make. Naming the home as a beneficiary of your IRA or your retirement plan, your life insurance plan, or even a payable upon death. A lot of people don't realize this. If you have a checking account, any type of account like that, savings account, payable upon death, you can name a person or a charity as a beneficiary. This last one is my favorite, donor advised fund. I don't know if anybody here has a donor advised fund, but right now, in donor advised funds, there has been an incredible growth in donor advised funds in the US. There was just a report that was put out for the 2024 numbers. There's over $250 billion in donor advised funds. So that's with like Fidelity, Schwab, Vanguard, or your community foundations like Boston Foundation. But there's so much money in donor advised funds, and they're wonderful giving vehicles. But what a lot of people don't realize is if you have a donor advised fund and once you pass away, if you haven't named a successor charitable beneficiary or a successor advisor, that donor advised fund is not going to continue to give to the organizations that are important to you. It will just go back into that larger donor advised fund pool, whether it be at a Fidelity or at a community foundation. So I tell it to a lot of my donors, make sure if you have a donor advised fund and you want it to continue to support an institution you love, be sure to either name a successor advisor, so that could be your spouse or it could be a child or your best friend, to make sure that those distributions are continuing, or name a successor charitable beneficiary so that you know if you have a donor advised fund that is supporting the home right now, name the home as your successor charitable beneficiary so they continue to get that. But the difference between these two, so if we think about the benefits, flexible and easy to arrange, easy to modify, yes, 100%. The one thing to keep in mind, these top two bullets here, you do need to have a lawyer involved in that, or at least somebody that can give you legal counsel. There's a lot of online options where you can to write a will. That's wonderful. It's really helpful to get you started. And a lot of them, they do follow state regulations, but you really want to have somebody look at it just to make sure that your wishes are carried out. So you're going to need to invest a little bit in some kind of legal advice, whether writing a new will, making a codicil or an amendment in a will. Down here, you don't need anybody to help you with this. It's a matter of going online to your retirement company, whether it's Fidelity, at Boston College, we have TIA Craft that does it for us, filling out a beneficiary designation. So you can go home and do that tonight. Life insurance, the same type of thing. Easy to do it online. Well, I'll take that back. Most of the insurance companies, you can do it online. But I think we all know you have to still print some things out, figure out how to scan it. So it's not always easy. It's easy-ish. Donor advised fund, very easy to do that. Again, online. And I will say, many of these large donor advised funds are making it much easier now for you to name a successor charitable beneficiary. So when we say here, one of the benefits that it's flexible and easy to arrange, it is-ish. It's probably the easiest to do, but easy to modify, 100%. You could have a will now in place and then decide, all right, I want to give 50% of my assets to the Home for Little Wanderers. Go home and you can work with your attorney and draft a codicil to add them to it. The wonderful thing about a bequest is you retain control of those assets during your lifetime. There's a lot of tax saving potential for you and or your heirs. You're going to be removing things. If you're giving it to a charity, you'll remove that from your taxable estate, if you have a taxable estate. And like I said before, you're going to have a bigger impact than you think you might, or that you would think would be possible. So a lot of reports say that about 10% of a person's wealth is in cash. The rest of it, the 90%, it's in real estate, your home, your vacation home, or a retirement account, things that aren't easily liquidated right now, or things you have to live in your home, so you're not going to liquidate it and give it away. You might need those retirement assets during your lifetime. But if you're putting those in your estate plan, leaving it to an institution you love, it's a gift you can't make today, but you can make it tomorrow and have a huge, huge impact. I know for our three largest estate gifts, those were all real estate. Real estate that people didn't want to give up, they didn't want to give up control of, but once they passed away, and we're talking, if I do the math, 8 and 9 figure gifts. Those are really outsized, but they're wonderful. So again, having a bigger impact than you think might be possible. Do I have any questions before I go on? Okay. And one other thing about how easy it is, this is just an example of what you can do. You can say, I want to give, I want to make sure, my mom, my neighbor, my niece, all my friends, they get $10,000 each. And then whatever's left over, the residual, have it come to a charity, have it come to the home. Or you could do the reverse. You know, I want to give $500,000 to the home, and then the rest can go to people. Or don't give it to anybody. You know, I see that all the time, people getting written out. I'm not saying do that, but it happens. Contingency, we see this a lot, especially with younger families. They want to support a charity, but they know I need to take care of my kids, so I want to make sure that they're taken care of, my spouse is taken care of, so everything's going to go to them, but if for some reason they don't survive me, it will then go to a charity I love. And typically people should be updating their estate plans every 3 to 5 years. I see it more, it's more like every 7 to 10 years, or at like some big life event. You know, if they have young children, it's when the kids go away to college, or when the kids have moved out, or if there's a marriage, divorce, death, retirement. And that's when you can change contingencies. So any questions? Honestly, these are the bread and butter of every institution. They're just so easy to do, and you can have the biggest impact. Now come some of my favorite types of gifts. These are really fun. So life income gifts. When I first started doing this, back in, I was gonna say 2020, back in 2000, yeah, so it's been a long time, back in 2000, I was at Harvard, and I remember they were explaining to me how a life income gift worked, and it just didn't sink in, because it didn't seem like this could be something that was possible. Like, how can somebody give a charity money, get money back, and get a tax deduction on top of it, and it's still considered a gift? Well, it works, and it's a great type of gift. So life income gifts work just in that way. You give a charity money to set up, in this instance, a gift annuity, or, and I'm going to talk about it in a minute, a remainder trust. You, as a donor, you or named income beneficiaries get income for life. Then whatever is left over in that principal, the remainder of that principal, then comes to the charity. So how this works, for this example here, you have a donor who is 65 years old, and the minimum to establish one of these here at the Home for Little Wanderers is $25,000, and that's pretty standard across the board, anywhere you go. So you have $25,000, 65-year-old, they get a 5.7% payout. And so what that means is that payout is based on their age, their actuarial age. There's a lot of math that goes into it, and the IRS tells you this is what you can do to determine what the charitable gift annuity rate will be. Home for Little Wanderers, they use it's called ACGA, the American Charitable Gift Association. They set, American Council on Gift Annuities, there we go, American Council on Gift Annuities. They set the rates for charitable gift annuities for, I think, about 99% of the charities in the nation use those rates. So the 5% payout would be what a 65-year-old could get. The older you are, the higher your payout rate is, because your actuarial lifespan is shorter. The younger you are, the lower the payout is, because you have a much longer actuarial age. The standard at most institutions is about 60 years old to start a gift annuity, because quite honestly, anything under 60, it's, for lack of a better phrase, not much bang for your buck, and it's not that beneficial either for the charity. So 60 is a good age to start. 65 is where we see a lot of people doing this, 65, 70. This example, 65-year-old, $25,000. They're gonna get $1,425 annually. Now that's a fixed payment. It will never go up. Even if the principal is going up, it's always 5.7% of $25,000. So it's a guaranteed fixed income for you or your named income beneficiaries. Even if the principal goes down, it's still going to be that $1,425. You also get a charitable deduction in the year that you make the gift. So the donor, whether or not they're the income beneficiary, they get a charitable deduction. And in this instance, it's $9,000. So it's just a win-win for everybody. You have fixed income for life, charitable deduction. You get to save on gift and estate taxes, because this will come out of your taxable estate. And then the remainder, whatever's left in that balance, transfers at death to the Home for Little Wanderers. Typically, the remainder that's going, it can be anywhere between 50 to 80% of what that initial gift level is. It really depends on how it's being invested. So it's a wonderful gift for everybody. We see a lot of people doing this as income to augment their retirement plans. We had a gentleman, we started a little younger for our age. He was age 50 when he did it because we also, you can also defer your income. So let me just give you the example of what that would look like. In this example, and I'll tell you about the gentleman that did it for us. If this 65-year-old says, you know what, I don't need this income until I'm 70, they would be eligible for a 7.9% payout because we base that on their future age. They would get a $10,224 charitable deduction, and their income would go up to $1,975. So we had an alum who was age 50, and he knew he was going to retire at 65. He did 2 deferred gift annuities a year to age 65. He turned 65, I think it was last year or the year before, so it was, 30, because he started at 50, it was 30 annuities. He had this all planned out. He knew he was going to get, he was a teacher, he was going to get this pension, this amount for retirement, support BC, and then get all of this extra income, fixed income, that would never go up or down.
You get taxed on that income?
It's a blended income, yeah, so there's,
You get taxed on that income.
it's not all straight ordinary. It's based on the actuarial lifespan. So let's say the actuarial lifespan is 15 years. People quite often outlive their gift annuity too. So if you want to live long, you always establish one of these. But so for the actuarial lifespan, it's a blend of ordinary and tax-free. But then at the end of the actuarial life of the gift, then it's all ordinary income. So it's a blend. It's a mix. It's good. Yeah. Any other questions on this? Yeah.
How do they determine the charitable deduction? And is it real? Because in recent years, you know, your standard deduction
Yeah.
more than we haven't been able to deduct charities for years.
That is an incredible question. It's a really good question. It is a real charitable deduction, but it's a good question. Will you be able to take it based on are you going to itemize or not? So when people are making these types of gifts, they're looking like what's my adjusted gross income? What are my other deductions that I'm going to take? Will I be able to itemize? And is this the piece that would put me over to be able to itemize, to be able to take the deduction? But if you're at the standard deduction, this may not benefit you. The income would benefit you, of course, and supporting a charity that's important to you would benefit you, but possibly not the deduction. The way the deduction is figured out, and it's not the full amount that you're giving, it's not the $25,000, because you take into account the income you're getting for life. That's a piece of it. So there's a few different things. The monthly discount rate goes into it. The income that you're getting for your lifespan all goes into it. There's a lot of math. Thankfully, we now have software that can do this. But when I first started, we had to do it by hand, and I'm terrible at math. So there's calculators that can help us with it. But it is a real deduction. But if you're taking the standard, you may not use it.
Okay, well, different venue or different strategy then.
Yeah.
Can you take the $25,000 from your R&D distribution? And then what happens?
That is a very good question. Oh, so the question for our recording is, can you take the distribution from your RMD to establish a gift annuity? You can. One time, right now, one time per taxpayer. It's like, so you can do per one taxpayer for your lifetime right now.
Oh, okay.
And I have a little slide that I can show you on that, but this just was allowed in 2023. It was a new rule that you could use your qualified charitable distribution, which I'll explain in a few minutes what that is, to establish a charitable gift annuity. So hold that thought, and I'll answer your question, I think, in like 2 slides. That's a really good question, though. But going actually back to your deduction question, so your charitable deduction, you can take that the year you make it, but you can also carry it over for 5 years. So if you can't use it this year, it could be carried over for the next 5 years too. So that's where you definitely want to work with an accountant, or if you're doing this yourself, to figure out, okay, this is not the year I'm making I can take a charitable deduction, but I will be able to carry that over to next year when I'm going to take the deduction. And it's all changing, as we know, since the standard deduction is going up a lot more too. Any other questions on that? No. Okay, charitable remainder trust. Oh, you know what? One thing I just want to make sure. For a charitable gift annuity, you can only have 2 income beneficiaries. Quite often, it's the donor that's the income beneficiary. It's more often than not the donor and their spouse that are the 2 income beneficiaries. I have seen younger people setting these up for their parents quite often. A lot of times it happens. We have a few people. We had somebody, I think it was his assistant that he set it up for, older retired assistant. So it doesn't always have to be a family member. You do have to take into account that the gift tax that might have to be paid. But whoever you work with, and you make sure you also work with your accountant to make sure that the income that's going to that income beneficiary doesn't count for a spouse, but that it always stays below that threshold. Or you just know that there's going to be a tax that you will have to pay, or it will be part of your annual exclusion or lifetime exclusion. But you can get 2 income beneficiaries with a charitable gift annuity. And the reason I say that is because charitable remainder trust, which is your other option, you can have multiple income beneficiaries on this. It's wonderful to be able to have multiple, but you also have to think the more income beneficiaries that you have, and let's say you do it for multiple lifetimes, that means there's less of a gift at the end for the charity. So just keep that in mind. More often than not, in charitable remainder trust, it's a couple. It's normally spouses that we see doing this. Sometimes you'll see a spouse and maybe 2 kids. So the way this works with charitable remainder trust, again, the same concept. You're establishing a gift, you get a deduction, you get income for life, or a term of years, and whatever's left in the principal goes to the charity. The big difference is it's not a fixed income. The income is based on the principal as it's revalued each year. And the other big difference is the minimum to establish. It's $100,000. That's standard pretty much at any institution that you'll see. So you have a higher entry point or gift point, and your income could be flexible. So in this instance, you have a 65-year-old. They're making a $100,000 gift. The standard payout rate, and this is not based on age, that is just a standard payout rate for trust, is 5%. Some institutions will go to 6%. At BC, we really stay at 5%. At the home, I'm at 5% as well. That would be the right way to do it. That means you're going to get $5,000 your first year. So if the principal goes up to, and just because I don't want to have to do too much math, let's say it goes up to $200,000, which would be an incredible market year, but let's say it did, that means you would get $10,000 in income next year. But if it goes down to $90,000, you're only going to get 5% of the $90,000. So your income's variable. The way these work, you want a little longer lifespan, longer. I always recommend people in their 50, like between 50 and 70 to do this, so that you have time for the principal to grow, because the market's going to go up and down, but you're always going to have a trajectory. Well, always, knock on wood, but you're going to typically have a trajectory going upward. So the income up and down a little bit, but you know that principal will most likely grow. So you want to have some time to see that principal grow. You get a higher, well, in this case, because it's $100,000, you get a higher charitable deduction, but you would anyways, just how the math works.
Well, the minimum to establish is only $10,000.
$100,000. Oh, I missed a zero. I need new glasses. Thank you.
He gets extra credit.
Yeah, you really do. Yeah, it's 100,000. Yeah. Also, and going back to the question about the income, so income from a remainder trust is ordinary income. But one of the things for a trust, a lot of people will use securities because there's total avoidance on capital gains. So people will use securities to establish these. Again, you can save on gift and estate tax, and the beauty is that it also transfers to the charity that you love. Any questions on this? Nope, okay. Answering your question now, the qualified charitable distribution and RMD. So I don't know if people are aware of this, qualified charitable distribution. Years ago, we used to call it the IRA rollover. Not a rollover from one IRA to the other, but an IRA rollover gift. But it really is a qualified charitable distribution. So the donor must be 70 and a half and older to qualify for this. You can take a distribution directly from your retirement account and have it transfer to a charity. It has to come directly from that retirement account.
You can't touch it.
You cannot touch it. If you get the income and then you write a check to the charity, it's not qualified. You'll have to pay taxes on that income. So there's a whole process. You can call your plan and say, I want to do a QCD. Also tell the charity so they're aware it's coming. Right now, this year, you could do up to $108,000 per taxpayer, per IRA holder in a tax year. So if you have multiple IRAs, you can take it from many IRAs, but it only can add up to $108,000. If there's both spouses have this and have their own IRA, they can do it separately. So that would be $216,000 you could do. This amount will go up next year. It's been going up based on inflation. They haven't announced the number. I'm guessing 110, 111, somewhere in that range it'll probably go up to. It can only be made from a traditional or a Roth IRA. Again, it has to come directly from the administrator to the charity. This is the beauty of it. It can count towards your RMD. And so you can start doing this at 70 and a half. You don't have an RMD until you're 72 and a half, but once you hit 72 and a half, it will count towards your RMD or your required minimum distribution. Yeah.
Forgot what that is.
Yeah. Yep. And the other big thing, it's not eligible for deduction, a charitable deduction, because you already got all the tax benefits.
It's already a deduction because you're taking it out of your IRA.
That's a big deduction. But you can, if you're 70 and a half and older, you can one time in your lifetime use it to set up a gift annuity, but it's only half of that amount. So this year you can do it for $54,000. But if you set one up this year for $54,000, you can't do it ever again.
You have to do it again.
Right. For now, as we've seen, like this rule here, they started allowing this in, I think, like 2007, and it was a type of thing on December 20, somewhere between the 25th and 31st of each year, they would say, you can do it. So we would be rushing to tell all of our donors, you can make a distribution from your IRA. They finally made this permanent in 2016. So there's a lot of us that are lobbying to make this a permanent thing that you can do every year versus just one time in your lifetime. So, but it might take 10 years for that to happen, but it will get there. I believe it will. Any questions on that? This is a great way to make annual gifts. This is a great way, if you have like a multi-year pledge, anything like that. It's just a wonderful, wonderful tool. We have a lot of people that use this.
But I'm using it
Excellent.
to a competitor though.
Okay.
That's Boston.
Okay. Well, Henry will talk with you. And don't forget, if you have your IRA, I'm thinking DAF anyways, but actually, if you have your IRA, beneficiary designation, this is a wonderful opportunity to think about naming the home as a beneficiary of this too. Just saying. On naming it as a beneficiary on this? No, but it could depend on your administrator. Most of them, we've seen distributions, and I think the smallest was $15. But there are some administrators that will say, we won't write a check for less than 100 or what have you. So it just depends on your plan. But for the charity, no, there's no minimum on what they'll accept. The plan administrator might have a minimum on what they'll do. Okay. Before I talk about this, I'm not an accountant, just want to say that. I'm not a tax advisor, but these are some things I wanted to point out that might be helpful for you as you're thinking about your charitable giving, what you might want to do this year versus next year. So the OBBBA, the One Big Beautiful Bill Act, was passed this summer in July. It's about 806 pages long, something. It's very long, but there's a small section in there that deals with charitable giving, deductions, and things that are important to us as we're thinking about our giving. And so at Boston College, we put together some like kind of things you need to know or things you need to then take to your accountant, advisor, and ask, is any of this applicable to me? Do I need to be thinking about this as I'm thinking about my own giving? So as we were talking about the standard deduction, the high standard deduction that we see now was brought in on the Tax Cut and Job Acts in 2017. We thought it was going to sunset and go away, but with the OBBBA, it became permanent. So now you have a very high standard deduction, which, what is it now? It's $15,750 single, $31,500 joint. Next year, it's going up to $16,100 for single filers and $32,200 for single filers. So what this means is a lot of people might not be itemizing. That standard deduction it's a nice thing to take. On top of that standard deduction, there's a senior boost. There's always been an enhanced senior deduction for anybody who's 65 years and older. That's still staying. That's a long-standing deduction that's been around for a long time. But this is an add-on to it where you can get up to an additional $6,000. Now, there's phase-outs based on your adjusted gross income. For a single filer, it's adjusted gross income of $75,000 up to $100,000. There's a threshold where it will end. But so that means you have the potential for taking an additional $6,000 on top of that $15,750. And that starts this year, this tax year. And then next tax year, there's another add-on that's coming in. And this was built into the OBBA to kind of incentivize charitable giving. For charitable gifts, you can make a $10,000 gift, but you can use $1,000 of that to deduct if you're a non-itemizer. You can add that on top of all of these deductions. So that's just something to think about. So this is this year's standard deduction. This starts this year. It does end. It's set to end in 2028. Could be extended. Who knows? This one doesn't start until January 1st, so that's next tax year. So those are some things as you're thinking about your giving. What do I want to do this year versus next year? A couple other things that you might want to think about. What am I going to give this year versus next year? Is this itemizer threshold. So right now, gifts are only, well, not right now, starting in 2026, gifts will only be deductible with 0.5% of your AGI. So what that looks like, say you have an AGI, adjusted gross income, of $100,000, and you make a $10,000 gift, only $9,500 of that will be deductible starting next year. So yeah, you might want to think, do I want to make a bigger gift this year so it's fully deductible? That's just something to think about. Now, if you're in the top tax bracket, this is another thing. So if you're in that 37% tax bracket, your tax savings starting next year will only be at the 35% tax level. So let's just say you make a $100,000 charitable gift. This year, you get the 37% tax savings, so $37,000. Next year, it's capped at $35,000. So you'll only get tax savings for $35,000. Again, not an accountant or a tax advisor, but these are things you might want to take to your accountant and say, does this apply to me? What do I need to think about for my giving this year versus next year? Just something to put out there. Yeah, I thought I had a question. And then the other thing, the last but not least, the gift and estate tax exemption has been, for now, permanently extended at that higher level. So this year it's $15 million per individual and $30 million per couple. And so those are just a few things. This page is in that, the little handout. So if it's helpful, take it to your advisor. What do I need to know? What do I need to do? And on that, so questions. But before we do questions, so going back to Edna Betts Talbot, if you do any of these types of gifts, any of these types of planned gifts, you automatically become part of that society. And I think Henry told me you had about 60 people right now currently in that society. It's a wonderful group to be part of. So as you're thinking about, how you want to support the home, just keep that in mind. You too can be like Edna. Yeah, but any questions, anything that I can help? Oh, and there's also contact information in here. So you can call the home and say, okay, what do I do? How do I do it? And David can help you with that. But I'm here now and happy to help with anything.
I have probably, I don't know, there's no such thing as a dumb question.
There is not.
So I'm thinking about this estate planning thing.
Yeah.
You've got the lawyer involved.
Yeah.
Blah, blah, blah. So we're talking, this is all familiar.
Good.
I don't know it, but it's familiar
Yeah.
language. And one of the questions I have about this thing, about this, setting up something when I die,
Mm-hmm.
an amount of what in one of the trusts
Mm-hmm.
may come here. But what about in the interim? What do you do in the interim? You just, the home just has to wait for you to die to get the money? So,
Don't tell them that.
I mean, is that what it's about? You're
Well,
talking, you said,
continue living and volunteer to help them out while you're alive.
well, I mean, is that what?
There's that. That's a great question. There's also things like you can think about if you have an IRA, taking advantage of that, making some qualified distributions from that to support it today. Do what you can today, but then knowing that you may have the bigger impact at the end of your lifetime. Yeah. Yeah. It's all about thinking how you can do a little bit of both. Like going back to thinking about what a person's wealth is made of. People don't have that liquidity, that cash on hand quite often to be able to make those gifts. So it's doing whatever you can today to make an impact. If it's using the QCD, if it's what other assets you might have. If you have some stock, then you do need to be taking a charitable deduction this year, use the stock. That's a great way to make a gift. You avoid cap gains tax, you can make a gift, support the institution today.
But in order to do this thing that you want us to do,
Mm-hmm.
you need to put down some cash, something.
Well, it depends. Yeah, you either need to put down some cash, or if you're looking at one of the life income gifts today, or like you said, if you're thinking you have a trust or if you have a retirement account, that's not cash that you need to liquidate today. That's something you can do a beneficiary designation for the future. Yeah. So it can be a little bit of both. I mean, it's a really good question, and my advice is to, if you have a good advisor, somebody that you like, and they can see your full portfolio, to figure out, like, I know I want to make some type of gift today. They're going to help you figure out, okay, here's some assets you can use today, and then we're going to save the rest for tomorrow. It's a little bit of both. It's going to be the most beneficial for you and for the home at the same time. Does that answer your question? Kinda. Honestly, on that, without knowing the full picture, yeah, it's definitely talking to if you have an advisor, somebody that you really like working with, they should be able to help you figure out what you can do. But the QCD, if that's an option for you, that from your retirement, that's a good one. Yeah. Yeah, sure. Yeah. Any other questions?
Not a question, but I like your idea about that thing becoming permanent instead of a once in your lifetime.
I do too. Yeah. I think I fingers tightly crossed that we can make that happen.
I started doing direct contributions to UMB,
Ah, okay.
because then I avoid the tax on that.
Mm-hmm. Yeah. Yeah. Yeah, it's taken out of your RMD. It's great. You had a question here, I think.
Yeah, I'm gonna try to say this.
Okay.
So, if the goal is to pass on as much money to the
Mhm.
home
Mhm.
as possible,
Mhm.
whether it's later
Yep.
or gone,
Mhm.
or little bits and pieces now. Say there's some that's given now. Does the home invest that money so that it becomes bigger, or is it better off if I invest it
Mhm.
later on give it to you?
Right. I will let you answer this one.
So, by the way, I'm Todd Tooney, Chief Development Officer here at the Home Florida Waters. Thank you so much for being here and participating in this particular session. It's meaningful to all of us. I'm learning a great deal. I think hopefully you have as well. I was told earlier that I'm the guy that has his hand out trying to get your money. That's not the case. I'm not pointing at you again. But actually, the reality is all resources are important to us. And so that's why I love this, because it really starts to delve a little bit more into how you can support the home in different ways, and not just always about money, and how you can think about us, later in life, right? Our perpetuity. And so thank you for that. Thank you for being here and being a part of that. So to answer your question, yes, we do invest. In fact, we have a member of our board that's in this room right now, Tom, who's actually a part of our investment committee and helps us think through and understand what are gonna be the best vehicles for us to invest our money in. We have members of our board as well as members in that space to help guide that work for us. We also hold a lot of that money in Fidelity and other arms to be able to ensure that we are getting the best return for that investment.
So like a lot of charitable organizations, we have an endowment. Some of that is restricted, depending on how the people actually provided that money. Some of it's unrestricted, so we pay a lot of attention to that. We do have to use a lot of the kind of yearly type donations and the fundraising that Todd and his team does to supplement programs to help the home runs. And believe me, they do an unbelievable job. I've been on board for 2.5 years. It's amazing. Both what they do for the children and the young adults, but also the way they manage the home. They really do. I'm a finance guy. The way they balance those two, the fiscal fiduciary responsibilities and trying to make sure no child or adolescence goes, it's amazing. It's a huge, and they work really hard to make sure they get as much grant money and activities. But at the end of the day, we still need money. To your point, we need current money to help run the programs. But we really have a goal to try to build up that endowment, build out that investment fund. We do have debt, which I would like to see eliminated. I talk about it all the time.
That's seminars next week.
So the more money we can get, maybe we can, because we have to pay interest on that, and I'd rather that money go to the programs.
Thank you, Tom. The thing that I would add as it relates to the endowment piece, and we all have been through what happened 5 years ago with COVID. If it wasn't for Edna and Abigail and all those who had made kind of that commitment to us and had us be a part of their will and what they left for us, we would have put us in really dire straits. The fact that we have the endowment to pull on, and people, you get it on both sides. We're like, I can't believe you used your endowment. Well, the endowment was set up for a rainy day.
Yeah.
Guess what? We had a storm. We had, like one of the rainiest days you could ever have.
Yeah.
So we did. We tapped into that. But now our board is really committed to replenishing that because you never know what else could come. And we want to make sure. And I applaud our board during that time. Our board were courageous, and they said we're going to continue to maintain our staff. We're going to maintain our program and our services because what we knew is that coming out of COVID, that children and families were going to be struggling with mental health, and we wanted to make sure that we were able to support that effort during that time. And it benefited us hugely that we were able to do that. Now, yes, we've got an endowment that we need to replenish, we've got some debt that we went into, but we feel really good about where we're at. Thank you for mentioning that, where we're at right now financially. We've grown, we doubled the size of our work, which I think speaks to the need. And we're excited about what the future has for us as we move forward.
Remember how many employees there are at the home?
No.
I was blown away. Take a guess.
I have no idea.
11.
What? Wow.
For all the programs, everything.
Yeah, I mean, and there's other resources, but 1,100 employees across Massachusetts, New Hampshire, New York.
Wow.
We serve over 15,000 children and families on an annual basis as well. So it's a large.
It's a big. I say to Leslie all the time, you're running a company.
Yeah.
We have facilities that we maintain, that we own. My wife and I went to visit the one in New Hampshire this summer. It's amazing what they do. Amazing.
That's wonderful. Camp and school and residential facility, all in one. Yeah.
Any last questions, thoughts, anything?
Great job.
Thank you. Thank you. I really enjoyed doing this. Thanks.
No stealing our donuts.
I won't, I promise. I will encourage them to come this way. I really will.
I would like to, oh, go ahead.
I'm gonna go, where's your contact information?
My contact information is in there,
No, it's not.
but I will leave some cards, but anything I do will be to help the home, just so you know.
I would like to say thank you to Erica for doing this. She, just to get a little context, we reached out to people probably 2 or 3 months ago, had some conversations. David and I
There you go, if you wanna take it.
talked with Erica, we got off the phone, I texted him right away and said, I love Erica. Let's go with her.
Oh,
So thank you
Oh.
for being a part of this and making this.
thank you for having me.
I can promise you there will be no online quiz. But I will say, in terms of a planned gift, a lot of planned gifts are people like yourself putting the home in your will or in your estate plans. And I often tell people, if you do that, thank you so much. Please take your time
Oh, yeah.
in terms of when we receive a gift.
Yes,
As much time as you need.
yes.
So thank you for being
Yeah,
here.
we've only been around how many years?
The home has been here for 235 years. Tom, we're hoping you'll go to 150.
Great.
But thank you for being here. We have a wonderful reception, dinner, and a fireside chat. I'm sure if you have any questions, I'm sure we'll be happy to answer them. But for now, I'll sort of put a nice little bow and close out this little seminar. So thank you.
Yeah. Thank you, everyone. Oh, sure. Let's see if I can figure this out.